This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market stocks hit a one-week high today. They were helped by expectations that China will step up its support for its economy. Now, MSCI's index was up for a third straight day, led by Chinese stocks. It was also boosted by signs the trade war between Beijing and Washington was subsiding. On the continent, South Africa's JSE pushing higher in broad-based gains, of course in line with positive global markets, as we saw investors gauge the likelihood the UK will leave the EU without a deal. In Nigeria, pretty stagnant today, but we saw oil firm Seplat dragging on the oil share index, falling almost 10% on the day. Now, also coming up on the show, South Africa's national carrier is facing fresh turbulence. British Prime Minister back in Brussels for talks after surviving a threat to her political career. And President Trump's administration unveils a new strategy for Africa. Well, let's start off in South Africa. The country's state-owned airline is broke again. South African Airways has failed to turn a profit in over 7 years now. Instead, it has recorded heavy losses. Now, the government has had to financially assist the airline for years. It's likely to step in again, as, of course, the airline needs about $540 million urgently to keep it operational. Now, SAA was once Africa's largest and most popular airlines. As CGTN Sumitra Naidu reports, its demise is making way for other African airlines.
South African Airways' financial woes are far from over. By March next year, the airline will need a further $250 million to keep flying. A turnaround strategy forced the airline to cut several local, international and regional routes. Flights to Mumbai, London, Buenos Aires and Beijing have all been dropped. Lucrative routes that are being picked up by other African airlines.
You have shifts that have been made by South African Airways in terms of the routes that they service globally, which to some degree opened up capacity, left a gap in the provision of capacity connecting or servicing certain routes. You've also seen an aggressive move by South African tourism to attract, new operators or encourage current operators to take up additional slots in the different cities.
More international airlines are also capitalizing on the local market. British Airways has added a new London-Durban route and extra flights to Johannesburg. Lufthansa now flies directly between Germany and Cape Town, and Cathay Pacific has just launched a non-stop flight between Hong Kong and Cape Town.
There is a means now to not necessarily have to travel via the hub of OR Tambo International Airport to be able to get to Cape Town or to Durban. It increases the options that passengers have to move around both South Africa and then obviously to get to and from South Africa back home.
The airline also shaved several African routes earlier this year, including flights to Brazzaville, Kinshasa and Luanda, creating opportunities for regional players.
We would support intra-Africa network development and growing of flights, because as part of the whole single African air transport market, we're looking to expand flights into various parts of Africa. And I think that some of those markets which SA have at the moment withdrawn from, there's a huge opportunity to increase the network from South Africa through to those destinations.
SAA is expected to report a $370 million loss in 2019. The airline is only expected to return to profit in 2021, by which time it may lose its place altogether in the African airline industry. Sumitra Naidu, CGTN, Johannesburg, South Africa.
Well, let's get the latest on the airline's performance from Sumitra Naidu. She joins us now in Johannesburg. Very welcome to the show, Sumitra. Now, of course, a lot of drama going on right now with South African Airlines. We hear relations between the CEO and the board have deteriorated so much that a state shareholder rep, Pravin Gordhan, has had to basically intervene. So, Sumitra, any insight into what is behind this breakdown in the relationship, of course, at the top of the airline?
Well, Uche, I don't know if it's really a case of a relationship breakdown here. I spoke to the SAA spokesperson this afternoon and he said it's not the case. The CEO has no intention of going anywhere and is focused on the turnaround strategy that is being implemented at this moment. There have been several meetings with the Public Enterprises Minister as well as the Treasury. As you know, the turnaround still needs hefty sums of money, and the CEO did outline the amounts needed for this turnaround and asked for full support from the board. Whether he's getting that support might just be an issue here, and whether they're actually going to get that money because they need it pretty soon. Now,
of course, Sumitra, new CEO Vuyani Jarana, he took over the role in the tail end of last year. We've seen him push back the airline's target to be on a sustainable path by 2020. Now, last month, he also said, as you mentioned, that the airline needs over $1 billion from the government or commercial banks in order to continue operations into 2019. Has there been an improvement in the airline since we've seen him take over the CEO role?
Yes, that's right. So that the airline still needs that money, and quite urgently, especially since many of its creditors are no longer keen on assisting the airline. Of course, a large chunk of that amount is debt that's owing about $650 million. The rest is for operational costs and to get the airline back on a firm footing. Higher oil prices are pushing that date out to 2021. But Jarana did say a few months ago that they've managed to streamline some of the operations. Unfortunately, the turnaround strategy meant cutting some routes internationally and on the continent, which have been done already. The staff cuts he was trying very hard not to do. They've also brought the low-cost airline that it owns, Amango, under one stable and moved over about 4 aircraft to low-cost flights, which is seeing some improvement because there is still increased demand for cheaper flights. So that seems to be working now, and they're still on track to meet the targets set out under the turnaround strategy in the next 3 years.
And of course, the airline has been a drain on government finances for the past decade. We've seen it receiving over $4 billion in government bailouts. Now, commercial lenders have also closed the taps, which we've seen has led to calls by some, such as Finance Minister Tito Mboweni, that the airline be closed down or sold. What do you expect 2019 holds for South African Airlines?
Well, I think it's still going to be tough times for a few more years. I mean, they're expecting to report a heavy loss next year. SAA has received over $4.2 billion in the last 20 years. It has, as you say, been an ongoing drain on the fiscus. And, you know, we've heard the ratings agencies warning. They've flagged the airline a problem child that needs to be addressed urgently, along with other struggling state enterprises. And, you know, despite numerous calls over the years for the airline to be privatized or even part privatized, the ANC has refused to budge. You know, even the unions are opposed to the move. But the new Finance Minister Tito Mboweni, you know, has said that there's no point in holding onto an asset that's not actually working and instead draining money. At the medium-term budget in October this year, he was frank. He used the example of Swiss Airlines, saying it was, you know, struggling at one stage. The government sold it off, Crossair took it over, and in fact, it's now owned by Lufthansa. And he says, look, the name is still there. Everybody knows it as Swiss Air. People still think that, you know, that airline is government-owned. Maybe it's time that SAA goes, let it get back on track, and then the state can look at, you know, re-owning it at a later stage. But right now, something needs to be done to get this airline back on track. Otherwise, it needs to go because it is draining this fiscus, and money needs to go to more urgent places.
Well, of course, we'll certainly be watching. Many thanks, Sumitra, as always, for your insights. Sumitra Naidu joining us there in Johannesburg. Well, let's head to Zimbabwe now, where De Beers and vast resources will now be allowed to explore for diamonds. This will make them the first listed companies to mine diamonds in the country for 2 years. Now, prior to that, state-owned Zimbabwe Consolidated Diamond Company was one of the 2 firms currently allowed to mine diamonds. Now, the other, Murowa Diamonds, is the only private company mining diamonds in south-central Zimbabwe. In early 2016, long-term leader Robert Mugabe's government evicted all diamond miners. Their licenses were not renewed after they declined to merge under the state-owned mining firm. Now, Zimbabwe has since been working to rebuild investor confidence, but some investors are concerned about how much money companies can take out because of dollar shortages. Meanwhile, oil fell for a second day by 0.5%, and that's after sliding 1% in the previous session. This comes after the International Energy Agency says it's too early to tell whether output cuts by OPEC and its allies will prevent a surplus. Now, crude's still in a bear market after reaching a 4-year high in October, as investors remain worried over supply and demand. Record American output, which is expected to boom to more than 12 million barrels a day in 2019, is threatening to overwhelm the market. The U.S. has also allowed some nations to temporarily buy Iranian oil despite the implementation of sanctions, while the unity of the Organization of Petroleum Exporting Countries is at risk. Meanwhile, Egypt's central bank is to issue treasury bills worth around $1 billion in 2 auctions. The move is the country's bid to search for revenue. Now, foreign investments in government debt instruments have reached about $17.1 billion. That's since the flotation of the Egyptian pound. This, of course, is lower than the $23.1 billion recorded at the end of March 2018. Egypt, of course, is seeking about $28.5 billion from the domestic market to fund its 2018 and 2019 budget. Now, the rest of the funds will be raised from external financing through bond issuances as well as an IMF loan. And turning to East Africa now, the exit of Nakumatt from the Kenyan market has paved way for South African retail brand Shoprite to establish its maiden outlet in the country. Now, the retail brand signed up a market leader in retail leasing, Knight Frank Kenya, as the anchor tenant of Westgate shopping mall back in March. The leap by the retail store is seen as an advance in the market in terms of investments, as well as providing employment for close to 200 people in the country. Shoprite, of course, is also planning to open more stores, including one in the Garden City Mall and others in Mombasa by January 2019. Shoprite's entry will record further growth in footfall with its enriched shopper experience.
Shoprite is a huge organization in South Africa. They have made various forays up into Africa. What they've chosen to do in Westgate is very, very exciting because they trade as Shoprite and as Checkers in South Africa. And Checkers is the upmarket brand, very, very high standards.
As a High Commissioner of South Africa in Kenya, I think this is a long overdue. And I guess that with the notion that as African countries we must do business among ourselves, I'm very excited about it. It have taken a bit of time, but the fact that 2018, and not only 2018, but a day after Kenya have celebrated 55 years of their independence, on the 56 days we are opening a South African supermarket. I'm over the moon.
Supply of the goods, I found it quite comprehensive. They have got the stocks and all the varieties, and hope things will be better and they will catch the bird at a proper time.
let's take a look at some other corporate headlines today. Japan's Toyota Motor Corporation controls about 57.3% of all motor vehicle sales here in Kenya. That's according to the latest official data on automakers' market shares for used and new models. Now, this is the first time that the exact dominance of Toyota has been disclosed in numbers. Together, Japanese firms including Nissan Motor Corporation, Honda Motor Company, as well as Isuzu Motors account for about 91% of all vehicles sales in Kenya. Meanwhile, South African gold producer Sibanye-Stillwater says it has extended a wage agreement to cover all of its South African gold workforce. Now, the move has potentially put an end to a strike that has seen almost half of its employees down tools since mid-November. The company said in a statement that the extension means all members of the Association of Mine Workers and Construction Union, as well as employees not represented by a union, are bound by the agreement. And African Airlines are expected to report a $300 million net loss in 2019. That's according to the International Air Transport Association. This will be a slight improvement from the $400 million net loss in 2018. Financial performance is expected to improve compared to 2018 in all regions except for Europe, where improvement has been delayed by the high degree of fuel hedging. And lawyers for the Nigerian government say they have filed a $1.1 billion lawsuit against Royal Dutch Shell, as well as Italy's Eni, in a commercial court in London, which of course is in relation to a 2011 oil field deal. Now, the oil field is also at the heart of an ongoing corruption trial in Milan, in which former and current Shell and Eni officials are on the dock. The Anglo-Dutch company filed a criminal complaint in March against Peter Robinson, a former vice president for sub-Saharan Africa, saying he took bribes in the $390 million sale of the oil field to a Nigerian firm. And that's a look at our corporate headlines. Well, let's head into a short break now, still coming up. Britain's Prime Minister is back in Brussels for talks after surviving a threat to her political career. And ECOWAS members explore means sustainable exploration of mineral resources in the region.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
Beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible and why?
Let's get some reaction on ground. Joining us in Johannesburg is Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself. If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back. Now, Britain's Prime Minister May is back on the road and she's trying to lobby European leaders for help over Brexit. In Brussels, Theresa May met with her Irish counterpart, Leo Varadkar, and will sit down with European Council President Donald Tusk. Now, her trip comes after she survived a parliamentary mutiny with the backing of 200 Conservative Party members. But May also confirmed she will step down before the next national election.
People try to talk about dates. What I'm clear about is the next general election is in 2022, and I think it's right that another party leader takes us into that general election. My focus now is on ensuring that I can get those assurances that we need to get this deal over the line, because I genuinely believe it's in the best interests of both sides, the UK and the EU, to get the deal over the line, to agree a deal.
Now, Santa has delivered his traditional end-of-the-year rally on Thursday as we saw world stocks make a third day of gains, and the pound and the euro both staying strong after the latest bout of Brexit drama. Markets reckon that Prime Minister May's continued premiership for now makes a no-deal Brexit less likely at the margins. Now, her survival takes at least some of the immediate headline risk out of the market, even if the Brexit impasse is really no clearer. Now, the pound was trading at about $1.26 in early trading in London, still well up more than a cent from the 20-month low set early on Wednesday, and at about the level seen just before the vote results came in on Wednesday night.
It was an unnecessary distraction, if I'm honest, but certainly I think the markets took it in their stride. We got a rally in the pound yesterday on the expectation that Theresa May would win the confidence vote. I don't think it was really in any doubt. The only doubt revolved around the margin of victory, and I think, if anything, the margin of victory tells us that the deal as it is pretty much dead, because even if she's able to get some tweaks from the European Union, unlikely to get enough tweaks to satisfy all of them.
Political uncertainty is something that currency markets generally do not welcome, and there's a lot potentially on the score. Now, which way Brexit happens or behaves will very much dictate which way sterling will go. So the sterling investors will welcome a soft Brexit. They would welcome no Brexit, because of course that is no different to the status quo that we have now, so that would remove just about all uncertainty, and they certainly would not welcome a hard Brexit. So the outlook for sterling is very contingent on what happens to Brexit over the next 3 months or so.
Now, as May struggles to lobby the European Union, let's get the latest on that EU summit in Brussels. Mariam Zaidi now joins us, of course, in Brussels. Very welcome to the show, Mariam. Now, currently it seems like all roads lead to the issue of that Irish backstop. May says she'll be showing EU leaders the legal assurances that her MPs want. However, the EU does not seem willing to renegotiate this backstop. So what is the latest on that discussion?
Hi, Jay. Well, the latest is just that, really. From what we're hearing and what we have been hearing for the last few days, the EU leaders are saying the deal is done. The UK is going to find it very, very hard to get the EU to really change tack so late in the day. Now, Theresa May really may be bowing to the politics of her party, but the EU will not entertain her Brexiteers. A draft of the political declaration on Brexit for this summit has been leaked, and some say that any backstop will be an insurance policy, only that it would be in place for a short period of time and only for as long as is strictly necessary. And also will add that the Union stands ready to examine whether any further assurances can be provided. Such assurances will not change or contradict the withdrawal agreement. Now, this would not, of course, be that legally binding promise sought by the Brexiteers in Theresa May's party, and the backstop would not be used to bind the UK into a customs union indefinitely. We are waiting, of course, for a press conference later this evening, so a little bit more later. Uche? Too. But despite, Merkel and the Dutch Prime Minister, for example, speaking of their admiration for May, we also had Austria's Chancellor who said it was hard to give assurances because not all arguments of Brexit supporters are rational.
Of course, given the recent threat we saw to May's premiership, how does the EU feel about the possibility of a no deal going forward?
Well, you know, the summit agenda specifically states that they will discuss no-deal Brexit preparations, and given the turmoil in the UK, well, you can't really blame them. The real problem now is that time is running out. The UK leaves, of course, on March 29th. The UK has not requested to extend Article 50. The vote the UK Parliament will have will be in January, sometime before January 21st, and there are, of course, no guarantees that they are going to adopt the Brexit deal. And then if they don't, then what happens for the UK? What happens for UK Prime Minister Theresa May? Does she finally perhaps relent and give the people a people's vote? Will the Labour Party perhaps try to wrestle control and then try to renegotiate themselves with the EU? So it's all pretty chaotic.
Certainly is. Well, many thanks, Mariam, for your insights. Of course, Mariam Zaidi joining us there in Brussels. Well, let's head back to the continent now. Côte d'Ivoire's economic capital, Abidjan, was the host of the second edition of the ECOWAS Forum on Mining and Petroleum. Now, the forum was a platform showcasing the development as well as potential of the mining and petroleum sectors in the West African sub-region. More details with Alexandria Majala.
600 delegates, including mining and geological experts, investors, government officials, as well as members of civil society, attended the ECOWAS second edition of the Forum on Oil and Mining. West African nations used the event as a platform to better exploit their natural resources with the help of foreign investors. However, sharing revenue streams from mining and oil extraction with local communities remains a bone of contention.
The mining sector in Mali is one of the most prosperous sectors in the continent. In the field of gold, we are the third largest producers in Africa, after South Africa and Ghana. We have so much natural wealth in all kinds, and the country is full of large deposits of oil. But the people in our countries must be able to benefit from these natural resources.
In Niger, we started oil production in 2011 with a capacity of 20,000 barrels a day. A refinery was built just for domestic consumption. In terms of perspective, we now have over 1 billion barrels, and we expect to increase production by 2021 to 1,000 barrels per day with the construction of a pipeline. For the oil sector, the fiscal and economic conditions must be made much more flexible to attract even more investment.
In 2017, the ECOWAS region produced 2,254 barrels of oil per day. According to the latest estimates, it supplies 10% of manganese, 8% of bauxite, and 7% of uranium worldwide. However, many challenges remain.
The abundant mineral and petroleum resources place the region at the heart of global geostrategic issues. However, West Africa's mineral resources sector faces several challenges. Some of these include the following: low contribution to national wealth, fair income distribution, taxation, as well as local and regional development, inadequate human resources, low profitability and viability of local mining companies due to uncontrolled input costs.
After 3 days of discussions, experts present agreed to establishing, developing and organizing geological, mining and petroleum databases for ECOWAS member states. They will harmonize legal, regulatory and fiscal mechanisms, as well as catalyze and develop artisanal and small-scale mining. Participants also promised to add value to mining and petroleum products while strengthening their trade. Alexandria Majala for CGTN.
Now, Eritrea's President Isaias Afwerki arrived in Mogadishu on Thursday for his first ever visit to the country. The visit is another sign of rapidly changing relations in the region following Eritrea's rapprochement with one-time foe Ethiopia. Now, Somalia's President Mohamed Abdullahi's office said the visit was meant to boost diplomatic relations and explore areas to cooperate in security and investment. Ethiopia, Eritrea and Somalia have all been mending their sometimes fraught relations since Ethiopian Prime Minister Abiy Ahmed took office in April. Now, in July, Somalia and Eritrea said they plan to establish diplomatic relations as ties improved across the Horn of Africa following Eritrea's rapprochement with Ethiopia. And in Nigeria, the country's direct foreign investment has seen an increase of over 50% in the third quarter of this year. As CGTN's Phil Ihaza explains, the US, the UK and South Africa are amongst the biggest investors in the country.
According to the National Bureau of Statistics, NBS, Nigeria's foreign direct investment FDI rose by 50.75% between the months of July through September 2018. The country's FDI went up from a record low of $435.64 million in the second quarter of 2018 to over $530 million in the third quarter. This increase was largely due to foreign investment in the country's banking sector, real estate, service industry, as well as local research and development. According to African Development Bank AFDB, Nigeria is dealing with insufficient infrastructure for its nearly 200 million people in spite of the country's abundant natural resources. President Muhammadu Buhari's led administration has been making efforts to strengthen economic relations with foreign countries in the last 4 years as part of efforts to boost Africa's largest economy, which emerged from recession in 2017. Part of government's efforts have seen many top foreign leaders from Europe, America, Southeast Asia and Africa visit Nigeria in 2018 to explore investment opportunities, particularly in the construction of infrastructure like rail, airports and roadways. President Buhari, who's seeking to be re-elected next year, has promised to focus on reviving Nigeria's economy, something which many analysts believe contributed to his 2015 victory. Phil Ihaza, CGTN, Abuja, Nigeria.
You're watching Global Business Africa. Let's head into a short break now. Still to come. President Trump's administration unveils a new strategy for Africa. And China gets backing from the EU to push for reforms at the WTO.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges. From grassroots to big. Takes you a
Just about half past the hour, let's recap today's headlines. A fire has reportedly gutted 80% of the 10,000 voting machines in the DR Congo. Now, the incident has taken place just days before the long-awaited presidential vote, which is set to take place on December 23rd. The president's chief diplomatic advisor has blamed the warehouse blaze on criminals. Police who had been guarding the warehouse have been arrested. The introduction of the untested tablet-like voting machines for the election has been widely opposed by the opposition. Meanwhile, Eritrean President Isaias Afwerki has arrived in Mogadishu for his first ever visit to Somalia. President Afwerki was received by his Somali counterpart, President Mohamed Abdullahi Farmajo. Now, the Somali president said the visit by President Afwerki bears significance on bilateral relations and shows how the countries are determined to advance their cooperation. Meanwhile, Mozambique has named 3 top commanders from Renamo, the largest opposition party and a former rebel movement, to key arms as part of now threatening to continue with agitation. And Britain's Prime Minister is on the road trying to lobby European leaders for help over her Brexit plan. In Brussels, Theresa May met with her Irish counterpart, Leo Varadkar, and will sit down with European Council President Donald Tusk. Now, her trip comes after she survived a parliamentary mutiny with the backing of about 200 Conservative Party members. But of course, May confirmed she will step down before the next national election. And that's a recap of today's headlines. With great economic potential. Analysts are saying Trump's administration has been rattled by growing relations between China and Africa. The U.S. is also wary of Russia and the European Union's presence. The plan, drafted by the White House National Security Council and due to be presented at a Washington think tank, will signal a shift by the administration that emphasizes America's rivalry with China and Russia as a top priority rather than an exclusive focus on fighting terrorist threats in the continent. Now, to discuss the outcome of that meeting further is Jessica Stone. She joins us in Washington. Very welcome to the show, Jessica. Now, of course, Trump's administration has shown little or no serious interest in Africa. We know they've cut foreign aid to the continent, foreign aid budgets rather. And of course, Trump himself has made some disparaging comments about the continent. Now, it seems this new strategy is more about countering China's growing influence in Africa. What are the highlights of Trump's strategy then?
Well, I think you're absolutely right that there has been a great wake-up call here in Washington about the importance of the African continent to the United States in light of what they see as a major competition with both China and Russia for investment and economic ties, which in turn, they say, result in political influence within the nations of Africa. So there was a statement to talk about this strategy very clearly directed at both Beijing and Moscow, that they are desiring to increase trade and investment to counter those two countries specifically. But there weren't a lot of specifics on how they're going to do that. We do know that they want to use economic development, trade, not aid, that they are not put any additional foreign aid, for example, on the table, and also that they are reevaluating their UN peacekeeping commitment and their overall foreign aid around the world in order to better target those resources and primarily get more private investment to Africa.
Now, Jessica, White House officials also say that this new strategy does not call for more funding this time, but rather using existing resources more effectively on the continent. How do we expect to see that implemented in this new strategy?
So that's the foreign aid review, but it's also something that they've already passed in the U.S. Congress and which has been signed by the U.S. President last month. And it's something called the BUILD Act, which basically combines many of the overseas lending institutions that help incentivize and provide credit and lending to American businesses to invest overseas, to incentivize them with about $60 billion to be invested in developing countries in particular. And it's also going to, for the first time, allow American companies to incentivize to actually purchase equity in these companies abroad. This is something called the BUILD Act, and it's so far been the only sign we've seen that they're really trying to equip American companies with the ability to compete with China and with Russia on the continent of Africa. But of course, even $60 billion is just a drop in the bucket when you talk about the promises that have been made by Moscow and Beijing. So we didn't really get a lot of specifics aside from that, and they have not given us any indication on when that foreign investment or foreign aid review will be completed.
Now, this new strategy is also expected to name several African countries as anchors for the U.S. on the continent. Was there any information as to which countries we could see being the focus in terms of those anchor countries?
You know, I wish I could say that they rolled out some of those countries, or even the political officials from those countries were present and talking to the press about what they see as part of their role in the strategy. But they did not name John Bolton, the ambassador, the national security advisor to the United States, didn't name any African countries that the United States is going to be specifically working with. Of course, you can imagine that the major economies like Nigeria and Kenya will probably be among them. But when I talked to one expert about what other countries would really benefit from that engagement, he talked to me about the developing and emerging economies, such as maybe Mozambique, even Zimbabwe, could be places that the U.S. could engage with to the benefit of those countries and to the U.S. market. Because a piece of this, of course, is this is not an administration that is really focused on grants, but on cooperative and win-win equations where the U.S. market can get more of its products into the vast and expanding African market as well.
Well, many thanks, Jessica, for that update. Of course, Jessica Stone joining us there in Washington. Now let's turn our attention to reforms at the World Trade Organization. The European Union, China and other members have jointly called for the unblocking of the appointment of WTO appellate body members. In a meeting of the WTO General Council, the members demonstrated their concern that continued vacancies in the appellate body present a risk to the WTO as a whole. Now, while reaffirming their commitment to the rules-based multilateral trading system, they underscored the dispute settlement system as a central pillar of the WTO. The appellate body functions as the WTO's de facto court of appeals and is composed of 7 members. However, only 4 of the 7 members are in office since Washington has refused to initiate the process to fill those vacancies. Meanwhile, the wealthy Sultan of Brunei on the north coast of the island of Borneo has been struggling to attract foreign direct investment, as we've seen the supply of oil and gas that made it rich start to dwindle. So the advent of the Belt and Road Initiative and China's increasing interest in the country couldn't have come at a better time. The state visit by China's President Xi Jinping in November will have helped raise Brunei's profile amongst Chinese investors. But as CGTN's Rian Melzer reports from the Brunei capital, Bandar Seri Begawan, Chinese money has already been flowing into an array of projects and industries.
This sprawling petrochemical and refinery complex, being built by the Hengyi Group on an island just off Brunei's coast, is China's flagship investment here, with the cost of the first phase alone estimated at $3.5 billion. It's the country's largest ever foreign investment. Across the Sultanate, Chinese companies are investing in infrastructure and logistics, finance, education, aquaculture, heavy industries, and there's no doubting what spurred this rapid growth. The Belt and Road Initiative has greatly raised awareness of and interest in Brunei among Chinese businesses and investors. China's Guangxi Beibu Group has formed a joint venture to manage, expand and modernize Brunei's container port and build an integrated industrial park.
Brunei provides us a stable and safe investment environment. With the improvement of the service and the efficiency of Mora Port, we hope to cut the logistics cost for Brunei and attract more foreign investment to Brunei.
Bank of China opened here in 2016.
We are becoming increasingly important as more and more Chinese companies are investing in Brunei. When we were coming in, Western banks like Citibank and HSBC were withdrawing. We have brought new confidence to this market.
With Brunei struggling to attract foreign investment, especially in manufacturing, China's growing interest has been a welcome tonic. HLDS produces steel pipes.
We have techniques and management experiences to share. As we're speaking, our products are being sent to all over the world. Our plan is to produce 10,000 tons of world-class quality steel pipes at a per year for the industries like oil and natural gas and construction.
And following President Xi Jinping's state visit to Brunei last month, it's likely that even more Chinese firms will be keen to see what opportunities the Sultanate can offer. Rian Melzer, CGTN, Brunei.
Well, let's head to the Middle East now. Dubai has long been seen as a business hub in the region, but there are signs that its economic recipe for success might be facing new challenges now. Here's Jacob Greaves reporting.
For years, Dubai's skyline has towered over its neighbours as a regional lure for expats. But it could be losing some of its shine. Some economists have suggested the city is showing a gross slowdown in white-collar jobs, such as financing and engineering, and pointed to external factors as part of the issue.
You have to look at Saudi Arabia, whose economy is twice the size of the entire UAE. As the saying goes, if Saudi Arabia sneezes, the rest of the GCC catches a cold. So if you're looking at demand trends in the UAE and Dubai in particular, you need to see the slowdown in the Saudi Arabian economy as one of the main reasons for this.
Dubai's property market is also going through a rough patch. The last government data concerning the second quarter of 2018 showed rental prices drop over 8% year on year. In some senses, Dubai has become a victim of its own past success. Its economic model giving rise to skyscrapers and commerce, drawing in talent and capital from around the globe, all out of what just decades ago was a desert outpost. That means it's become an example Middle Eastern countries want to replicate, leading to greater competition. As Saudi Arabia drives to diversify its economy, it's trying to entice more talent and investment. Dubai is also a changing environment for foreign workers, this year introducing 5% VAT. And promoting so-called Emiratisation, a goal to increase the presence of homegrown talent in the private sector.
Certainly the wage levels and the cost of living seems to be lagging behind what we see even in other GCC countries. So whilst I think Dubai's done a lot of work and UAE also in terms of ease of doing business, I think you can see places like Bahrain have got this interesting combination of ease of doing business and some improvements there, but also seem to be a relatively low cost of living and a more comfortable place to work.
Perhaps most importantly, the government has recently introduced a law permitting 100% ownership of some UAE-based businesses. Details are still limited, but it's a big change from the 49% ceiling previously in place. Undoubtedly, Dubai remains a regional hub. The question is whether it can still stand tall amid increasing competition. Jacob Greaves, the CGTN in Dubai.
Now, the concept of new retail has been picking up speed in the US and China. As CGTN's Miro Liu tells us, retail companies in Southeast Asia are now joining the chorus. They're providing shoppers with not only just products, but also the experience.
This may look like an ordinary grocery store, except you can't buy anything without an app on your phone. More and more e-commerce companies around the world are headed in this new retail direction. The main idea is to provide customers with a unique shopping experience that combines the best from both the physical and digital shopping worlds. Honestbee is a homegrown startup which began with providing users with personal shoppers who pick up and deliver groceries from traditional supermarkets to your doorsteps. It operates in a few countries including Singapore, Malaysia, Thailand and the Philippines. In October, the online company took some of its business offline.
I think companies want to be able to reach out to their customers. And customers live online today and they live offline. We live in the physical world and I think it's a job of every company to be able to reach out and get to their customers across all channels.
This concept has taken off in other parts of the world. US e-commerce giant Amazon and Alibaba's chain of supermarkets in China are iconic examples. China leads the world in e-retail, with about 83% of its population shopping online. But while new retail has gained momentum in the two giant economies, e-commerce chains in Southeast Asia are still finding their footing. E-commerce in Asia-Pacific accounted for 12.1% of retail sales between 2016 and 2017. Experts say that new retail is a way for e-commerce companies to tap into the shopping that still happens offline.
We like the space because it's really so-called spacious and we feel comfortable. And there's a lot of new concept food as well. And on top of that, there's a lot of merchandise that we don't see in a regular supermarket. That's what makes me come back for the second time.
I've used Honestbee online before for dry cleaning and stuff like that. But it's my first time in an actual store, and I guess because they have such a huge reach as a digital company, when they translate to a retail space, they're able to offer a huge variety, which might be hard for a more traditional supermarket.
Traditional stores are also dipping their toes in the new retail pool. In November, property developer CapitaLand, which owns 19 shopping malls in Singapore, opened Nomads, a multi-label concept store offering a new blend of physical and digital experience, including smart mirrors, interactive product walls, and cashless payment. CapitaLand's Deputy Managing Director Chris Chong says 70% of its customers still prefer to shop in stores.
Online shopping has its advantages. However,
brick and mortar will always have a role to play because shoppers will still like to come down and take a look at the new products they want to touch, they want to feel, and they want to smell. So these are things which the online platform will not be able to offer.
Well, this consecutive day, however, the metal did hover in a tight range ahead of next week's US Fed meeting, when, of course, the US is widely expected to raise interest rates. Meanwhile, oil prices steadying today under pressure from high inventories, but, of course, boosted by a drawdown in US crude stockpiles and, of course, indications that the trade war between the US and China may be easing. Well, let's take a short break now. Still to come. The junkyard business remains a moneymaker in modern Egypt.
The greatest journeys, the greatest sights, the greatest adventures.
Here in Qanater, this weir allows the locals to walk on water.
We're far more than just TV news. We're your passport to the wonders of Africa.
To bring you stories of struggle, survival and hope.
So let's explore. CGTN. See the difference.
Now in Egypt, every morning traders roam the streets with carts with the Italian phrase roba vecchia as their trademark cry. Now the phrase has been used since the early 20th century for junk collectors looking to buy or trade unused household items from residents. This is their story.
The familiar rhythmic chant of rag and bone collectors echoes every morning as they roam the Egyptian capital to collect used and unwanted goods. From household items such as beds and kitchen utensils to major home appliances like old washing machines and stoves, Mina the rag and bone man is interested. Over the years, the job has seen many changes, from apparent ones like shifting from handcarts to donkey-drawn carts and small vehicles, to less obvious changes such as competition from the internet.
I buy washing machines, refrigerators, stoves, scrap iron, aluminium and copper. But there were more items available in the past, now there are fewer. People now know everything, and if you have even a small piece of iron, they ask for a price based on price per kilo. In the past, it was just sold as a single item. Even copper mixed with iron was just sold as an item. But now people know everything.
People who want to make some quick cash off items that they no longer need trace the sound coming from the loudspeakers and find Thabet. Then the bargaining begins until Thabet and the seller agree on a price. But over the years, the job has become harder as people are more aware of the value of the items that they are selling.
In the past, we used to go into people's homes and we would find antiques and valuable items. But now with the internet, anyone who has something to sell offers it for sale online. Then they come and say many people are interested in taking the items. And so it has become harder for us to get these items. We take them for the highest price and try to sell them at affordable prices to the poor who want them.
The ever-changing nature of the job has brought on some changes. Though arguably one of the oldest trades in Egypt, the rag and bone trade still finds a way to stay relevant in our ever-changing world. Terry Wangari, CGTN.
Well, let's go to South Sudan now. China has donated farm machinery to boost the country's agricultural sector. Of course, the move is in line with South Sudan's plans to get its economy back on its feet. Here's CGTN's Patrick Oyet reporting.
Tractors, combined harvesters and irrigation equipment are just some of the machines being donated by China. These farm tools will be distributed throughout South Sudan, and Beijing will train workers on how to use them.
I hope we would take this as a small opportunity to plow the land of conflict and plant the seed of peace and harvest development and prosperity.
Beijing is one of the largest investors in South Sudan's oil sector and is keen to see peace return to the country.
Experts say the only way to end South Sudan's food insecurity is to encourage the population to farm for themselves, and with peace expected to return to the country, it's hope equipment such as this one will go a long way in transforming the country's agricultural sector.
The majority of South Sudan's population is dependent on subsistence farming. Many have been displaced by the war which began in 2013, but now, with a new peace deal underway, the government is urging those displaced to return home and prepare to farm.
We have known how we have gone wrong, and we have known now what we need in the area of food security, in the area of security, physical security to our people, to our properties, in our system of governance. We have learned a lot. So I think this time this piece is going to work.
China has also brought in experts to train South Sudanese people on how to use and repair the donated equipment. It's hoped that this measure will help get South Sudan back on its feet and quickly after many years of war. Patrick Oyet, CGTN, Juba, South Sudan.
Well, before we go, here's a quick look at how Africa's currencies performed today. Specifically, South Africa's rand strengthening early on Thursday as we saw signs of easing Sino-US trade tensions, as well as expectations that China will step up its efforts soon to aid its cooling economy, helping to support investor appetite for riskier assets. But we did see the rand slightly weaker in the afternoon against major global currencies. It did pair earlier losses after we saw the European Central Bank deciding to keep interest rates on hold today. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Okoronkwo, and of course the rest of the team, thanks for watching.